There's some key indicators that we look at when we're evaluating property, all right? First one is the cash flow. I know that sounds simple, and every real estate book you read should say cash flow, cash flow, cash flow, right? Even in the Bay Area, right, where prices are crazy, you still want to look at cash flow. That percentage may be low, but the property should cash flow versus being negative. Big problem in the old market, you guys. People bought property saying, I'm not worried about losing money. It's okay, I'm making 200 grand in my job. It's gonna go up, it's gonna go up, it's gonna go up. Did you hear anybody say that? Right? Sometimes it goes up, sometimes it goes down. What allows you to win in the worst periods of time is if you have cash flow, all right? It's real simple. In order to get the cash flow, we look at what's called the NOI details. NOI is net operating income, and the details surrounding that. That helps us to evaluate a property. Also, obviously, we look at the price as it relates to the cap rate. Cap rate stands for capitalization rate. I'll go into that. Return on investment and return on equity. This is not something you hear so much in real estate. You may hear it more in the stock world, return on equity, stockholders' equity, but it's just something that you need to look at if you own property. Return on equity doesn't mean anything to you if you don't own property yet, but if you own property, you got to look at that return on equity and what does that mean in your portfolio? What does it mean in your bottom line? All right? And then the last one is cash on cash return. That's the actual cash you're generating from the cash you put out. All right? Simple things, but easy to get lost in the sauce. All right? So I'm going to blast that over real quick how we analyze a building, whether it's a house for income that we're buying, if you're buying a house to rent it out, or you're buying a 100-unit, or you're buying a skyscraper. This is the stuff you want to look at, right? And you want to master it. You want to drill it. You want to practice. I guarantee you the Seahawks and the Patriots right now, everything they're doing in their practice, they've probably done 1,000 times this year, right? So when we're looking at a building, first thing we got to do is we got to start with the top line item. That's our rents and what's called the gross schedule rent. And you're going to get this number from what's called the rent roll. And I'll talk a little bit about that. The rent roll is going to tell you who's in the building, how much they're paying, when they moved in, when they moved out. And that's either for an apartment building, same thing for an office building, same thing for a retail strip center. So you get your gross schedule rents and you start taking away from that, all right? You take away vacancy, all right? Key thing to understand, within a building itself has a vacancy rate. A market also has a vacancy rate, right? So you may be looking at a building, perfect example. I'll talk about, at the end of my talk, a couple off-market apartment buildings I'm working on. But there's one that it's an 18-unit building, 7 units are vacant, right? That's terrible, especially in this market where you got like a 2.5% vacancy rate, right? So understand what the building's vacancy rate is versus the market vacancy rate. And you can figure out what the market vacancy rate is. You can go to marketsandmillerchop.com, Berkadia.com, and a bunch of other websites. If you just Google vacancy rate, I'm sure 10 of them will pop up. I recommend Marcus and Miller Chap, even though it's like a direct competitor, but they got some great research and it's free. Hit up their website and you can see each major metropolitan area in the States. And I even think they added Vancouver. I think they did add Vancouver and Toronto. And I think one more MSA in Canada. They'll tell you the vacancy rate, the rent rate, the price per unit rate, all these fabulous details you can get on the market. So research, know the vacancy rate of the building, know the vacancy rate of the market. Then from that, you take away something called loss to lease concessions. This is a forgotten number. This is when people don't pay their rent. This is when people, when you lease out units, sometimes if the rental market's soft, you may have to give away concessions, first month free. Come on in. First month free, no deposit. Right now, nobody's doing that. Nobody's doing that right now. However, a few years ago, first month free was pretty common. A $99 deposit was pretty common. So it depends on the market. Factor that into what you're doing. Factor that into your analysis. Now, when you take away from the income with vacancy and loss to lease, you have to add to it what's called other income. This is also an opportunity if you see a building that does not have other income, but could have other income. Other income is what? Laundry machines. A lot of apartment buildings, if you got a 4-unit apartment building and above, there should be some type of on-site laundry. If it's a big enough apartment building, it should be vending. And also there should be billboard, well, there not should be, but there may be billboards on the property. These are other ways of generating income that are not rental income. If you have a property that doesn't have it now, look for ways that you can generate income. If a property is big enough also, you can get a contract with like Comcast, or I think some of the satellite companies, but Comcast for sure. If you have a 90-unit building, you sign a contract with Comcast. Everybody in that building who signs up for Comcast, you get a like a royalty for it. It's like a $10 or $15 royalty. Not that much in and of itself, but it adds up. And I'll show you how it directly affects the value of the property. So look for other income. So your gross rents, gross scheduled rents minus vacancy, loss to lease, added to that other income, that gets you your effective gross. That's the real money you brought in monthly. It's the real money you brought in annually.